All right, welcome everyone. And in today's video, I'd love to do a top-down analysis on one of the Deriv pairs, which is the volatility index. And I would love to give a heads up for those who are not trading the Deriv indices. The Deriv is a broker and they have their indices, which is one of the best, you know, one of the best markets you should be trading. Now, giving a top-down analysis on how to analyze the derivative markets. The derivative markets is a program algorithm, but it is being programmed using the concept of market structure. So, meaning if you know how to interpret market structure, you know structural liquidity, you can um, be profitable in the derivative market. Right. So, first of all, I start my analysis from the monthly time frame. I'm sure you've heard a lot of traders talking about the top-down analysis. Some people start the analysis from the daily time frame, some from the monthly, some from the weekly. Rarely do you see traders analyzing from the monthly, but I do that because the monthly helps you to see where the market is going in a long term. All right. And, I'm not saying you should take your trades from the monthly. No, the monthly, the weekly, the daily, the monthly, the weekly are not for taking entries, are not for entries. But that doesn't mean you can't take entries from the monthly because everybody has a volume of equity they're making use of that. The volume of equity they are trading with. So because you don't have up to 50,000, $100,000 doesn't mean that somebody does not have that equity. So you can pick entries from any time frame, but it's not advisable you pick entries with the monthly or the weekly time frame, right? So now, this also helps if you are a swing trader so that you can know the long-term perspective of where the market is headed to. So that is it. I move straight into analysis. Now, if you are a derivative trader and you've not been profitable, you don't know how to analyze the market. Now, this is not for beginners. This is for intermediate traders who know the basic concept of trading. Um, you know your candles, you know what Forex is all about and all of that. So this is not just for beginners, for newbies. All right. So why I start from the month, like I said earlier on, is to give you a large perspective, the long-term view of where the market is headed to. That is why it's very important you start with your higher time frames. Whether you're a swing trader, whether you're a scalper, I know scalpers majorly make use of the the 1 hour time frame, 30 minutes, 5 minutes, and the lower time frames. But for a day trader, for a swing trader, you are looking from the monthly, weekly, the daily, so that you can have a long-term perspective of where the market is headed to. Now, we make use of the past data history to predict what will happen in the future. So first is all about predictions, all about planning, and so that you can know what the market is going to do next, in a day, in a week, in a month time, in hours. So this is the monthly. Now we could establish the fact that this market came on board around um 2019. This is the return index. The return index is not so volatile, but it has a moderate volatility movement. Okay, so first of all, I've established this as a high and a low. So, because this is the monthly, definitely it's going to take a lot of time before we have a break of any of this structure. Now, if there's a break to the upside, the market is telling us that, oh, this market is likely to be bullish. If there's a break to the downside, market is telling us that, oh, it's likely to be bearish. Now, what validates a break or what makes a valid break of structure valid, right? Firstly, you must see that there is a break of the previous candle, which is the last candle of that structure. That is what makes it a break of structure, not not this, not this, but this. This is the last candle in this whole region. So we have this market is telling that, oh, definitely this is going to be a bearish move, right? So when we have this becomes protected, telling us that this is not meant to be broken. First of all, it's going to be this. This is not meant to be broken because this is the last candle. This is the last candle. So you can ignore this, but if you do this, you are still right. If you do this, you are still right, but you can still ignore this because this is going to be considered as our swing high, right? So now we have a break of structure where we anticipate that, oh, this market is definitely going to be bearish. So if, for example, all this part has not played out, let's say all this part has not played out and we have just this candle breaking out, you know, the next thing is that we are going to anticipate what a pullback, right? So we are going to now go back to a lower time frame to now see what will happen next. So, but this has given us a bias of what, so a bearish move. Now we have this, we have a pullback, which can also be called a retracement, and have the break of this low as well. So we have another break of structure, giving us that market is still in a bearish move. Then this is going to be protected. Now, let me explain this concept so that you understand what market structure is all about. When we have a break to the upside, it means that this low is not meant to be broken, it's meant to be protected. Just like when you have a staircase going upwards, you see that it keeps on having um steps above and above and above and above. Right? But when it's coming down, you keep on having stairs below, below, below. So that's just the whole concept of market structure. So because we have a break to this downside, we expect that, oh, we should have another break to the downside, which is another step down. But if it is up, we expect another step up. So that is a simple explanation of that. Now we can see that we had a break of this as well. So we anticipate that price is definitely going to pull back, and we did not see the pullback. Not see the pullback. We can still consider this as the pullback, but we'll still get to this point, right? So we have this as another low, had this as another low, which was broken. And if this low is broken, it validates the fact that this high is meant to be protected. This high is meant to be protected, right? So when this low is broken, we expect a pullback, which is not meant to break this high. Then have another what? Another step. So I'm using the staircase analogy to explain market structure. So we expect what? Another step, which is a break of this structure. But unfortunately, the pullback had a break of this structure to the upside. And once we see this, the market has given us a pointer that it is going to be bullish. Once we see this break of this structure that is meant to be protected, the market has given us a point that the market is going to be bullish. So now we are no longer seeing a bearish momentum. We are now seeing a bullish what? A bullish movement. So now we would now say that this low, we say this low is now meant to be protected, which means price is not meant to break this low. So whatever is happening, whatever the movement is happening, we don't expect price to break this low because now price has broken this high and giving us what? A bullish bias. Let's move down to the weekly and see what the weekly is telling us if the weekly is now conforming to the monthly. So now for the monthly, remember for the monthly, you have to journal it. For the monthly, we can see the monthly is giving us a bullish move. Now for the weekly, let's quickly go back and it's still the same concept. We have what? We have our stairs downward. We have our stairs down. We have our structure down, which is the bullish market. Now the bearish market, sorry. Now because this is the weekly, we have to also analyze from the weekly. Let's assume we've not done, let's assume all these lines you are seeing here is not here. We're now doing the weekly and the weekly analysis, meaning that you ignore all this because this is for the monthly. You ignore all this for the month. Now for the weekly, we can see this a break of structure, can see the pullback or the retest, and see another break of structure. Now here is protected. We see another structure here. So this is also a valid structure. So let me move this here. This is a valid structure, meaning here is meant to be protected. Now, fortunately, yes, here is meant to be protected. We see a break of structure. We see another break of structure here. This is the weekly. Remember, this is the weekly analysis we are doing now. So we see another break of structure here, meaning that what? Meaning that here as well is supposed to be protected, right? But we see the pullback now broke this high, had a pullback, had a reversal, and also broke this high, which is also the same level with this high. So now for the weekly, we can now start looking for a bullish move since these two highs has been broken. But you can see that the market is still always right. We expect that this is now meant to be protected. But what happened? Market still broke this low. Since market has broken this low, this here has become invalidated. Then here now becomes our next major high that is not meant to be broken. I hope you guys are following this top-down analysis, because when you understand this top-down analysis, when you understand market structure, you really know where the market is headed to. So you are not really confused, or you are not among the traders that say, oh, Deriv is manipulating the market, or the market is being manipulated. You know that the market is always right in whatever it is doing. So now we can establish the fact that the weekly is also telling us to buy. So that means we now have a bullish move. We are no longer having a bearish move, right? Because here is now meant to be protected. So now we should look for our stairs, or our steps to be higher and higher and higher, because that is what signifies a bullish move. So now you note down your monthly is telling you that is a bullish move. Your weekly is telling you is also a bullish move, right? Okay, so today I'm not going to talk about entries. Throughout the videos I'll be posting for the month of January is going to be majorly on market structure. Once you understand market structure, you are halfway to your forex journey. Once you understand how to analyze, you can take any pair of your trades and you analyze it accurately. Then you really know what you are doing in the market, because this is very, very important. Very, very important. Now, moving to the daily time frame, you don't need to now go back and do all orders that you've done, because this is now a breakdown of what you've done from the daily, from the monthly and the monthly, from the monthly and the weekly showing. Now, the daily time frame, let's zoom in. Now, the daily time frame, remember the monthly and weekly is telling us a buy now. Now, whatever the daily is telling you, you need to also follow the daily trend, because the monthly and the weekly is saying buy, and the daily is showing you a bearish move. Doesn't mean that you cannot look for bearish setup and take the setup. But one thing you have in mind is that the long-term trend of the market is going to be bullish. That you should expect. So for it to flow with the trend for the long term, you should also look for bullish setup from the daily. Now, where did the daily now align with the monthly and the weekly? This is where the daily are aligned when we had a break of this structure. Now you see that you cannot, if you cannot wait till you see a break of structure to the upside, you can still as well, because this is daily. So it's going to really take a lot of time, it's going to take a lot of days, months, and weeks to form for the daily trend to end, right? I mean, for the bearish trend to end. Now you can see that we had a sell all the way down. If you have a sell all the way down, you should be looking for a buy setup. You should be looking for a sell setup. But you can see that immediately price broke from this high, this previous high that is meant to be protected. We now anticipate that the daily is already conforming to the monthly and the weekly, meaning that this low is now meant to be protected, which is this last candle here. So we expect that this last candle is meant to be protected, meaning we should not have meaning market is not meant to break this low. This now becomes our swing low from the daily time frame. So meaning that no matter what's happening, we expect that price is not meant to break this low. Now, if price should break this low, we know that from the daily, we still anticipate what the bearish movement. We still anticipate the bearish movement. Now, remember, this is our swing low from the weekly and the monthly time frame, but this becomes our swing low for the daily time frame. Now you can see that the monthly, the weekly, and the daily are all conforming to a buy, right? So you move to your 4 hours time frame, and this is where I end my higher time frame analysis. I prefer taking my trades from the 4 hours or from the 1 hour, list from the 1 hour. I know a lot of people say, oh, that means your SL is going to be large. Yes, my SL is usually large because this is where I take my trades. And this is the strategy I'm more comfortable with, right? So now we also have to also check and see if the 4 hours is also conforming to, to the bullish trend we've been seeing from the monthly, the weekly, the daily. Now we can see that there was also a bearish move here. Also a bearish move here. Let's move to the daily. This is where the daily gave us our book of short to the upside, and we expect that there's going to be a pullback to this zone. Now, this is where I'm still going. This is another class entirely. But what I'm focusing majorly on is on market structure, right? This is market structure. So if we are seeing this from the daily, I will move to the 4 hours. 4 hours is also giving us our bullish trend, because remember, this is where we had a break of structure from the daily time frame. So now we have a bullish trend, and from the 4 hours, you can see the market is also from a bullish trend. So from the 4 hours, you look for your setup. Like I said, I'm not going to emphasize more on entries for this and for this video is mainly on the market structure. And you can see that there is now a change of trend from here. I see there's now a change of trend from here from the 4 hours. Now, you might be asking, why do I stop my analysis from the 4 hours? Because the 4 hours is also one of the stronger higher time frame. The 1 hour is not really as strong as the 4 hours. So the 4 hours is likely a better and stronger higher time frame where I stop my market structure analysis, and I also take my trades from here. I believe you've learned something from this video, and gives it a like and also subscribe for more content as this. I would still drop more analysis on more pairs of the Deriv markets. See you in the next video. Have a great day.